We often hear that one of the blockers to moving to cloud or changing IT models is the capex to opex shift. So in this presentation, I'm going to be giving an accounting 101, detailing what the capex to opex shift really is, and giving some tips on how to tackle the conversations about it. Accounting 101. So in accountancy, you have a profit and loss account and a balance sheet. The profit and loss account is there to show how profitable an organisation is. So it shows the net income, it then shows costs, so IT costs, other costs, which would be staff costs, facilities costs, etc., to give total costs, also known as opex, operating expenditure. You take your opex away from the net income to get operating profit. Now this is a really important measure because it's what is used to show the overall profitability of the day-to-day trading activities of the organisation. So this metric is also used for remuneration schemes. You then take away depreciation to get the overall profit or loss. The balance sheet is there to show the worth of an organisation. It comprises assets. An example of an asset is a prepayment, which is payments relating to the future. So in accounting, you have the matching concept. You basically want the profit and loss account for the month to only show income and costs relating to that month. So if you've prepaid, say, a year's worth of service for something, you put it to the balance sheet as a prepayment and then drip feed it back in to the profit and loss account each month as a type of cost that it is. Something else you'd put to the balance sheet is hardware, so those physical assets with a life of over a year and a value over a certain amount. Now that amount changes depending on your organisation's policy. It's often around £5,000, and so because it has a life of over a year, you only want to see a month of its life in the profit and loss account. So you drip feed the cost of it back into the profit and loss account as depreciation over the life of the assets. As you can see, some assets come back in above the line of operating profit and others below the line. Other assets on the balance sheet, property, cash, stock, amounts owed by customers. The balance sheet also shows liabilities, which is the amounts owed to suppliers and loans, and equity. So some accounting terminology. CapEx, this is capital expenditure. So when on-premise, this would be lots of things in your data center, the hardware, the storage, the networking. These are expensive items that you expect to have a life of over a year, usually 5 years. And so it goes to the balance sheet as CapEx, it comes back in as depreciation. In public cloud, there's a shift from CapEx to OpEx. So there really isn't any CapEx. So OpEx, this is operating expenditure. So on-premise, it's the facilities costs and the general running costs. In public cloud, it's everything. The infrastructure and the cloud services, because it's on a consumption basis, you're paying month by month based on what you've used. And also SaaS, software as a service, this is operating expenditure. Whether it's CapEx or OpEx, one thing is for sure, there's going to be some cash going out the door to pay for it. So on-premise, the cash flow could be spiky because you've got the 5-year refreshes, things could break down, you'd have to replace it. And as we said, these are expensive items. So that's sort of spiky, large cash flow. In public cloud, it's more predictable and steady because you're just paying for what you use. So let's have a look at demonstrating this on the profit and loss account. The IT costs will go up because you're now paying for the new cloud platform. That will push up your total costs. So therefore, your operating profit will go down. Because you've no longer got all the hardware, storage, network in your data center, your depreciation will go down. And in this really simple example where we've got IT costs going up by 100 and depreciation going down by 100, you can see that the overall profit or loss stays the same. So this is a really simple example, and those figures will change depending on your organisation and the assets that you currently have. But what this is trying to demonstrate is that it's just shifting costs from depreciation up to IT costs. So when you stand back and look at the overall picture, nothing has changed. It's just accounting nonsense of where it's going on your profit and loss account. And that's the message to take away from this. Understanding that it's a shift on where you're accounting for things on the profit and loss account. That at the end of the day, things aren't changing that much. We often hear people say, oh, there must be some way around this. Is there a magic wand? What if we buy a reserved instance? So here we've got some capex acid tests. So these tests are the tests to see whether something can be capitalised. So is it attributable to acquiring or constructing an asset? And an asset must be owned and able to be turned into cash. So of course with public cloud, it isn't an asset because it doesn't meet that criteria. So even if you buy a reserved instance, you aren't owning the asset. The public cloud provider owns the asset. So with a reserved instance, for example, you are committing to buying something for 1 to 3 years. So you'll prepay that. So remember we said we'll put it to the balance sheet and then drip feed it back into the profit and loss account as IT costs. But it won't be an asset. It'll be an asset that we depreciate. It'll be on the balance sheet as a prepayment. Project costs. If you're building your own data centre, you can often capitalise your project costs because they're going towards constructing an asset. But because you'll never own the public cloud, you can't capitalise those project costs. And software as a service, that's where these bottom two asset tests come in. So the customer doesn't have the contractual right to take possession of the software, and patching gets done by the provider. So for these reasons, software as a service cannot be capitalised. This is a really complex subject, so for more information, please speak to your accountants and your finance team. So some key takeaways on how to deal with the capex to opex shift. Always collaborate with finance. They're there to help you, and with any project, please get them on board at the outset. The sooner that you involve and collaborate with finance, the better. Then understand the appeal of capex and raise the awareness of the shift, but understand there is no magic wands. Be led by the right thing. So just because costs will move on the profit and loss account doesn't mean you shouldn't do it. Be led by the right thing for the organisation, not just something to make the operating profit look like you want it to. And it's changed, so there will be some resistance. But things do change. Years ago, organisations used to buy company cars themselves and have them as assets. Now they realise, what's the point in doing that? They're not in the business of owning cars. Cars are only going to go down in value as well. So it's much better just to lease a car. And so that's what we see now, lease programmes. And finance are changing as well. So in this latest Gartner survey, it showed that 62% of CFOs would rather have speed over cost on the focus of the IT department. And another 62% of CFOs would rather have small bets rather than big bets. So thank you for listening to me today. I'm Louise Wayne from Jisc Cloud Solutions, and we're here to support your transformation journey.